Lesson 3. Tools for Economic Stability. Now, these are a list of some of the tools used by central banks to maintain economic stability. We have interest rates, price limit, language, and quantitative easing. Now, interest rates. Now, this is the main tool used by central banks to maintain economic stability. Central banks mainly use this tool to control inflation. Okay, so whenever there's increased inflation, the central banks look to increase interest rates. And whenever there is decreased inflation, the central banks look to lower interest rates. And the next tool used by central banks to maintain economic stability is price limit. And this is a tool used by central banks to prevent their currency from passing a certain price. Okay, for example, let's say the Euro USD is currently at a price of 1.12, and the central bank does not want the Euro USD to fall below a price of 1.100. So whenever the Euro USD begins to fall to 1.100, the central bank will buy the Euro USD. The central bank would actually spend millions to keep the Euro USD above that price limit. So that's how central banks maintain price limits. They actually pump money into the market to keep the market from falling below or above a particular price limit. Okay, so this can be very lucrative because if you know that the central bank has implemented a price limit, then you can use this to your advantage. For example, the Swiss central bank, they had a price limit that they had implemented to prevent their currency from becoming too strong. So this is a tool used by many central banks. We also have language. Now language is simply comments made by the central banks that are aimed at affecting change in an economy. Now, an example of language is hints of raising interest rates. So let's say the Federal Reserve hints that they are going to increase interest rate. What this will do is cause the market to react as if the central bank has already increased interest rate. You'll find in Forex the anticipation of the event is more powerful than the actual event. If the central bank comes out and hints at raising interest rate, this can cause the market to move hundreds and hundreds of pips. So language is something that you have to pay keen attention to. We also have quantitative easing. This is simply printing money to boost the supply of money in an economy. Now, printing money weakens a currency. So whenever you see a central bank hints at implementing a quantitative easing program or QE program, we know that that currency is going to fall. Okay, so this can be extremely lucrative for fundamental trader. So as soon as you get news that a central bank plans to implement a QE program, you can expect the currency of that central bank to fall because quantitative easing weakens a currency. Now in the next lecture, we'll discuss the importance of focusing on the central bank.